Hello everyone, I appreciate you joining me today, and we're going to talk about how to find the right mortgage for you. There are a lot of factors that I'm going to take you through in the various chapters of this video, and in the end you can make the decision that you believe is right for you. And if you're still unsure, you can contact us at dreamhomefinancing.com and we'll help you out with that. But also, if you're finding that this video is helpful for you, please hit that thumbs up button for me. It definitely helps the algorithm, so that way more people get to see this video. Okay, now one of the first things that you need to consider when determining what type of mortgage you need is the residency. And I don't mean your residency as a United States citizen, although that also could play a role. But what the home will be to you. Is it going to be your primary residence, a second home, or an investment property? Depending on what that is, that might steer you in a different direction as to which loan you might need. So for example, an investment property, you can purchase an investment property without any income documentation, without a job. It's just a different type of loan. And even though you can qualify for a conventional loan, for example, to purchase an investment property, the income requirements and all the other documentation just might not be worth going through that trouble, and you also may not qualify for as much as you need because you still have to qualify full doc, including the mortgage you may have on your primary residence. Okay, so the next thing is property type. Whether you're buying a single family house, multifamily, a mobile home, there are various mixed use property. All of these different property types might work better with one type of mortgage versus another. Even though you can finance most of these with everything, the one may be more beneficial than the other depending on what it is that you're looking to purchase. And then the other part of that is the property condition. If the property is in dire need of repair while you're buying it versus whether it's in perfect move-in condition, that may change the type of loan you would get too. So for example, if the home is going to be your primary residence and it needs a lot of work, and you also have a small down payment, you may want to consider the FHA 203K rehab loan, because the repairs do not have to be made by the time you close, and you could include the funds needed to make those repairs or updates as part of your loan amount. And it also comes with just a 3.5% down payment. So that's why all these factors I'm referencing will help steer your path into the right mortgage program for you. The next chapter we're going to talk about, or element, will be credit scores. So now for credit scores, there are certain mortgage programs that have a minimum credit score requirement, while others allow for much lower credit scores. Like FHA, you can go all the way down to a 500 credit score. Conventional, you need scores in the low to mid 600s, depending on the lender, before you could qualify for a conventional loan. So depending on your credit scores, that will steer you into a specific either one type of mortgage, or allow you to qualify for many types of mortgages based on your scores. The next thing with credit would be credit events. So if you've got a recent foreclosure, if you have a recent Chapter 7 bankruptcy, or if you have a recent Chapter 13 bankruptcy and maybe you're still in the middle of it making payments, those situations might steer you to a particular mortgage program that works for you. In the last one I mentioned, Chapter 13, while you're still making on-time payments, you can get a USDA loan, but you cannot get a conventional loan. All right, so, I meant to say you can get an FHA loan, but not a conventional loan. Those are things that will need to be considered when determining what mortgage is right for you. And by the way, you don't have to figure this all out yourself. You can contact us at dreamhomefinancing.com, linking down below, and we'll just help you walk through all these steps together pretty quickly. Work history. So most of these loan programs require you to have a 2-year work history, and without gaps in employment. Now, although the guidelines specifically don't say you need to have the same job for the past 2 years with no gaps, There are lenders that, and most lenders will require that to be the case. So if you're working with a lender that says you have not been at your current job for 2 years, you're not going to qualify, then again, reach out to us because we can make this work for you, even if you've switched jobs and even if you have a bit of a gap in employment. We look at everything to make that determination. So, but you should be able to qualify for most mortgage programs, even with a gap of employment. Now let's look at the income documentation. You will have to provide W-2s if you're a W-2 wage earner, and tax returns for the last couple of years, a couple of months bank statements, any retirement statements that may bring additional liquid assets to the table to help you qualify for the mortgage that you want. If you're self-employed or if you're 1099, you're going to have to qualify based on the income you do document on your tax returns. And if you don't show enough, then there's another mortgage program, a bank statement loan, where you're not providing tax returns but only bank statements, your average monthly bank statements to help qualify. Or maybe you earn cash and that would be managed differently, and it'll be more difficult to qualify for a traditional mortgage if you just make cash. So depending on how you make your money and what you can document on your tax returns, that will also steer you to a different mortgage program. Now, next chapter is down payment. The more money down you have, the more programs you have available to you. Even though with conventional loans, you can still put a very small down payment down. But typically, when people have a small down payment, they're going for an FHA loan. But your down payment that you have available to you will also dictate the type of mortgage you have available that you would likely prefer to get, depending on how much you have to put down. And that leads us to PMI and mortgage insurance. So with a conventional loan, if you put less than 20% down, you absolutely have PMI. But at some point, when you have enough equity in the home, you could get the PMI removed. With an FHA loan, you're going to have their version of PMI called MI, mortgage insurance, and it's for the life of the loan. So unless you put more than 10% down, then you can get rid of it after 11 years. Those are the guidelines as I'm recording this video. So depending on your appetite for holding on to the PMI, that might make a decision for you that'll create a decision point for you, is what I meant to say. So now let's talk about if you're not buying the house and you're looking to refinance, you're not sure what type of mortgage is right for you. So you're going to have a few things to consider. First, the type of loan that you have right now. So depending on the type of loan you have, you may have an option to just go with a streamlined refinance, like the FHA streamlined refinance that doesn't require you to document income and doesn't have a minimum credit score requirement, although your credit score might play a major role in the rate you get, but those are much easier to qualify for if you can get a streamlined product of the loan that you currently have. Another factor here would be your equity position in your property. So depending on how much equity you have, that might determine what type of refinance you want to get. And in some instances, for people where market values have gone down, maybe they purchased a home for $200,000 using a USDA loan, and now property values came down and it's only worth $190 and you owe $195. These are all things that would matter quite a bit when trying to refinance your house. That's why equity position is important. And the purpose for the refinance, are you just trying to refinance to get a better rate? Are you trying to refinance just to lower your payments, to cash out equity, to get an ex-spouse off of the mortgage? There are a lot of different reasons for the refinance, which could lead you to a specific type of mortgage program. And I mentioned cashing out equity. That's another reason why your equity position would matter. So for example, if you want to cash out equity, the most you could cash out using an FHA loan is 80% of the appraised value of the house. Don't look on Zillow or anything like that to figure out what your house is worth. It's after a real appraisal. So, that's going to determine as to your equity position will definitely determine what mortgage you can get if you're cashing out. So those are the basics of what I think you're going to need to evaluate when determining which mortgage program is right for you. It's really difficult for me to go through and give you all the what-if scenarios for each of those things I mentioned to tell you which mortgage is right for you, because a lot of these things are interconnected. A lot of the factors that I mentioned are tied to one another. So like I said, please reach out to us. And if this video was helpful to you, please hit that thumbs up button for me. It definitely helps the algorithm and helps me to bring more videos to you and to everyone else that could definitely benefit from this mortgage advice. Thanks again, everyone, for watching, and I hope to see you in the next video.